Hi, my name is Ranjit. Thank you for joining me. In this video, we're going to look at a financial market update for the month of January, primarily in the regions of the United States and the European Union. Let's begin with bonds. Bond yields fell in the month of Jan, and there are three possible reasons for rise in bond prices. One, bond markets are pricing in peak inflation in 2022. Two, bond markets are pricing in a possible recession in 2023. And three, after struggling with low interest rates, pension funds are de-risking from equities and adding bonds to their portfolios. It could be a combination of all three, but the most likely reason is possibly that pension funds are de-risking from equities and adding bonds to their portfolios at current yields. It is true that inflation shows signs of cooling off in 2022, but is this too early to call it a win? That remains to be seen. Inflation, while it's dropping, it's nowhere near the target rates set by central banks in the United States and the European Union. In the euro area, inflation has dipped to 9.1% in December from a high of 10.6 in October, but remains well above the 2% target rate by the ECB. In the United States, inflation has fallen from a peak of 9.1% in June 2022 to 6.5% in December. While this is a sign of peaking off, this still remains well above a 2% target rate of the Fed. In addition to this, in the United States specifically, we see the services PMI continues to rise, which is seen in the yellow line on the graph on the right-hand side. This could still be a concern for the Fed. We're going to hear more about that from the FOMC meeting later today. The Fed chair might probably address this concern. There is also a risk of sticky inflation due to high oil prices if geopolitical tensions escalate. Monetary tightening, we're moving from quantitative easing to quantitative tightening. Now, according to the Fed and the ECB, monetary tightening is set to continue in 2023. The Fed, for example, has from April to December of 2022 reduced its balance sheet by $500 billion. The ECB has also begun to shrink its balance sheet. We'll hear more about this later today from the FOMC press conference, and we'll hear from the ECB tomorrow, Feb 2nd. Let's look at GDP data. In the United States, GDP grew at an annual rate of 2.9% in Q4 2022, after increasing 3.2% in Q3 of 2022. Now, according to the US Bureau of Economic Analysts, consumer spending was the one that set off a decline in housing investments in the last quarter of the year. Now, while there's been an increase in the year-on-year data in consumer spending between Q4 of 2022 and 2021, it does look like consumer spending is probably flattening out. It'll be interesting to analyze this data over the next few months to see if US is going to avoid a recession this year. In the EU, according to data released on 31st Jan, the GDP grew 0.1% quarter on quarter and 1.9% year on year in Q4 of 2022. So the EU has effectively skirted a recessionary scenario since they beat analyst estimates of negative growth quarter on quarter in Q4. We'll wait and see how GDP growth evolves over the next few quarters of this year. Let's look at corporate earnings in the US. 165 companies of the S&P 500 have reported earnings so far. and the EPS growth is negative at minus 2.4% year on year, and companies have warned of a weak outlook. The current price earning ratio of the index is 18.1, which is an earnings yield of 5.5% on the S&P 500. Now, if you compare that to a 2-year treasury yield of 4.2%, it looks more attractive from a risk reward perspective to invest in a 2-year US treasury than equities. So this is a risk for US equities at this time. Corporate earnings in Europe: 386 companies of the Stock 600 index have reported earnings so far, and earnings per share has grown 7% year on year. Analysts estimate that corporate earnings will probably bottom out in Q2 and Q3 of this year, so that will be interesting to watch. The index is currently trading at a forward PE of 12.8, which is an earnings yield of 7.8%. Compare that to a German 2-year bond yield of 2.6%, and equities is a more attractive investment in the minds of an investor. This is probably the reason why uh, the European indices have outperformed the US equity indices in January. Now, stock indices in both regions are off to a flying start, with unemployment continuing to remain at multi-year lows and inflation cooling off from its highs. Investors are leaning towards a shallow recession, if at all. However, with the current uncertainty in corporate earnings as well as global macro, equity markets look optimistic. And all considering, it may be better to err on the side of caution at this time. That brings us to the end of this video. Please visit www.claritech.app for more innovative market analysis, financial market updates, corporate earnings. None of this is expert advice. I am just learning alongside you. We can connect on LinkedIn. Thank you for watching. Please subscribe to our YouTube channel. I hope to see you in the next video. Bye bye.